Happy Friday once again, market rebels, and what a day to round out a fairly volatile week here on Wall Street. I was just looking a few minutes ago, and it looked like we were closing pretty close to the high, up getting close to 2.5% on the S&P 500. But more importantly, as I talked about in Q&A, we were bouncing off the 1,000-day moving average, which is one of our key major moving averages. So it's nice to see that we're kind of holding at these higher levels. Also, today's candle closed pretty close to the high. It's what's called a Maribozu candle, which means a shaved candle. And that just simply means if you look at it on a green candle anyway, there's no upper shadow. That long line that you usually see on most candles is not there. It's as if somebody just took a razor blade and shaved it off. And what that shows is that we closed at the high. There was no other point during the day that was higher. So that just shows a lot of strength going into the close. So we'll have to see if that holds into next week. So for today, I know we all know what risk feels like, right? We don't even need any definitions for that. We know what it feels like. But what if there was a way that you could visualize risk? And there is a way. There's a neat little technique that we can use. Now, I know a lot of you use E-Trade and Thinkorswim or Tastyworks and things like that. And almost all brokerage platforms that allow you to trade options will have some type of a risk graph. Some better than others, but they should at least give you something. I sometimes call it your GPS. It's absolutely critical for understanding what's going to happen as the stock price moves, as time moves, as volatility moves. All of these things you have questions about can be answered easily in these risk graphs. But without having to pull up a platform, is there a way that we can maybe sketch this out and get an idea of what we're holding or maybe what we're about to leg into? And the answer is yes. Now, before I continue, I want to make it very clear that I really can't teach this in the next 10 minutes or whatever. It's more just to show you that it can be done. So try to follow along the best you can. And this might even be a good topic for you to take up with a free coaching session and continue this discussion. So how can we visualize risk? Well, what we're going to do is to set up a couple of T accounts for those who have had accounting. We're going to put calls on the left, longs on the left, shorts on the right. We're going to put puts over here on the right. We're going to put the long puts on the left, the short puts on the right. We're going to list strikes down the center. And of course, we don't have to have just two. We could put lots of strikes down there depending on the strategies that we're trying to analyze. Now, another thing too is that I'm going to show you a simplified version because we could get more complicated where we're dealing with different expiration dates. But again, it's just to kind of give you a taste of what can be done. So once you get this set up, the idea is that you're going to kind of lay out your trade. If you have a long call, you could just put 1 under the plus column at 100 if you had $100 call. If you were long the $100 call, you could put a 1 here under the plus, and if you were short the 105, you would put a 1 under the minus, your long one and short one. So that's just how simple it is to lay out the trade or the strategies. However, once you've done that, there are a lot of different techniques. I'm just going to show you 3 of them that we can do to get different looks. And this is where the whole thing about getting a different view of risk comes in. One that you need to understand is a box spread. Now, a box spread isn't used much by retail traders. It's more of a floor trading strategy, but it's really an important one to understand. And here's what a box spread is. You're going to buy a call, let's say at 1 strike, and you will then maybe sell a call at a higher strike. You're going to buy a put at this same strike. You're going to sell a call at this lower strike. Now, take a look at what's happened. Do you see how that's a long distance between those? That's what I usually tell traders as a little mnemonic, as a way to remember that that is a synthetic long stock position. Just look at it like it's a very long distance right there. Of course, if you want to know the definitions, a long call, short put is a synthetic long. And that just means that that position, long a call, short a put at the same strike, will behave just like 100 shares of stock or stock at 100. Going to have the same risk graph. Now down below, we have a synthetic short position. It's just the opposite. And we can look at that visually by saying that's a short distance between these ones that we have down here. So again, it's just a short call, long put. Now, I want you to think about for a moment what's going to happen if you have a box spread on, if we put this into our account. Really nothing. It's like a T-bill. It doesn't really change the overall shape. And that's the beauty of it, but it will give us a different look as to what's going on. Now, the reason this is called a box spread is that if you connect these four pieces and connected them kind of visually, it looks like a box, right? So that's where that name box spread comes through. So that's one thing we're going to consider. Another thing is a conversion. Many of you who have had the options theory classes certainly know about revcons, reversals, conversions. But a conversion is where you're going to take, let's say, 100 shares of stock and then maybe match it up with a synthetic short position. You're going to sell a call and buy a put. Once again, that's a synthetic short. So think about it logically. If you're long 100 shares and you're short 100 shares, what do you have? Nothing. It's a way of kind of putting in some fake trades on this layout to adjust things to get a different look. And that'll make more sense in a little bit. We can also look at reversals. Maybe we're short 100 shares. Maybe we buy the 100 call and we short the 100 put. Again, that is a synthetic long position. So think about it again. You're short 100 shares and you're long 100 shares synthetically. What do you have? Long and short 100 shares is, again, a big zero. So what that tells you is we haven't really changed anything about the profile of the trade, but we can change the way that it looks. In other words, we can find things that have exactly the same risk profile, but by using different assets. So for example, let's take a look at a butterfly spread. And for those of you who might know, let's say do it with just the calls. We're going to buy a call at 100, let's say, sell two of the 105s and buy the 110. All right, so there's our 1 to 2 to 1 ratio. Got it laid out over here on the calls, just like I talked about. But now, let's get a different look. What is a butterfly spread equivalent to? Well, there's actually a lot of things that it's equivalent to, and this is where it becomes interesting. One, we might say, let's put in a synthetic short and a synthetic long. So again, I'm going to ask you, what did we do? If we put in a synthetic short and a synthetic long, it's a big zero. It's a box spread. It didn't really change anything, but it's going to change the mix. All right, so it's a little bit like if you've had or remember basic algebra, you add 5 to the left side, you add 5 to the right side. You didn't really do anything. You changed the form, but not really the values. That's what we're doing here. We're just changing the way that it looks. Now start canceling out stuff. What do we have over here on the left? And this is, by the way, the reason that I chose the synthetic short up here in the top. Those are going to cancel. What else can we cancel? I've got a 1 on the left and a 2 on the right. On a net basis, that gives me 1 on the right. What have we got? 2 credit spreads. So this is a short iron butterfly. And this is a very simple way to show that a debit call butterfly is exactly the same 100% as a short iron butterfly. But too many times traders like to do the short iron butterfly because they hear the word credit. And that is never, ever the reason for doing it. We do it because of skews or potential morphs. And this is another way to show that they are absolutely identical. Okay, so kind of cool. You get the idea? Let's go back to the beginning. Let's do a synthetic long here. Now, why did I choose a long here? Because it's going to help me to cancel this guy out here. And let's put a synthetic short down here. Can I do that? Of course, I just did. You can put the synthetic long anywhere you want and the synthetic short anywhere you want. All you've done is added 0. So take a look over here. +1 on the left, -2 on the right gives us -1 at 105. Down here, plus and minus, those just go out. Now what have we got? Now we've got 2 debit spreads. This is actually what's called, we've got a built-in box position here, or what's sometimes called a gut butterfly, gut iron butterfly. I know not the most attractive name for a strategy, but that's what it is. We've got a box position in here. And it's exactly the same as a debit butterfly. It's exactly the same as a short iron butterfly. They are 3 different ways of doing the same thing. And this is a beautiful way to show it. All right, let's try another one. Covered call. Covered call, we need 100 shares, so we're just going to kind of tuck off the 100 shares. I guess technically we could create another account, but I'm just going to put 100 shares up here, and we're short, let's say, the 100 call. What is this equal to? Well, maybe to get rid of this 1 would be one way to get a different look, And to do that, I'm going to throw a synthetic long into the account. But I can't just throw a synthetic long into the account because that changes the values. What would I need to do to offset this? I would need to either put a synthetic short or a short. So let's do that. Let's throw in a short stock position. And what is this? This is a reversal. Again, a reversal is just a big fat zero. We've done nothing, but we've changed the look. So take a look at this. We've got plus and minus calls over on the left. They cancel. I've got plus 100, minus 100 shares. They cancel. What are we left with? A naked put at the same strike as the call. So yes, a covered call is absolutely the same thing as a naked put. This is a nice little check you can do for another risk check to say, oh, I want to do the covered call here. Ask yourself, would you write naked puts here? If you go, oh my gosh, there's no way I'd write naked puts. It's way too volatile. Then you shouldn't do the covered call. It's exactly the same thing. And now we can see it. Okay, let's try one more. Short iron butterfly. I like to show this one because, again, everybody loves the short iron, whether it's the condors or the butterflies, because they hear credits. And in fact, in this case, you're getting 2 credits. I go, what could be better? Well, what is this? Where is this credit coming from? Let's put our butterfly on. Let's put a regular butterfly. This is the debit butterfly, the one that nobody likes. What's one way we could get a different look? Let's throw in a synthetic short. And the reason I chose this is to cancel out this one. But we have to balance it, right? I can't just throw in a short position. I have to balance it. So let's do that by throwing in a synthetic long. Long and short is, again, a big zero. But we've changed the way that it looks. Take a look over here on the left. Those two cancel. Down here, I'm long 1, short 2, which gives me long 1. And what is that? There is your short iron butterfly. So how did we get to this position? Well, I took the debit butterfly and I just borrowed money. I shorted the box. So when you really realize it from that perspective, it's nothing really to get worked up over. You just did a debit butterfly and then you borrowed money and you said, oh, see, I got a credit from it. Well, yeah, you did, but you've also got a short box in the position. It's never for free. And that's probably one of the biggest themes that I always try to teach traders. It is never for free. So when you see credits in there, one of the things you have to learn to ask yourself is, where is the credit coming from? Why is the market willing to pay you that credit? And if you can't answer that question, then that hopefully that's really my motive here, is to show you that you certainly need education. It will help you tremendously in your performance and trying to figure out what you should do, what you shouldn't do, when you should hedge, roll, and morph. Because it's a beautiful way to simply look at risk. So for anybody who'd like to do that, as always, we invite you to take a free 30-minute one-on-one assessment with one of our world-class coaches. And the phone number right there is 888-809-8058. Absolutely free, 30 minutes. You might be able to talk to Stu, 29 years as a market maker on the Philly floor. You might get Elliot Katz with a SIBO. You could get Scotty Thorstensen. You've got so many great coaches out there that can all unload a ton of information into you very, very quickly. And that's really worth its weight in gold. So with that, I hope that helped. And again, if you didn't quite follow it, that's okay. My goal wasn't really to teach this. It was to instead show you some of the tools that you might not know about and some of the things that make decisions easier for professional traders when everybody else is scratching their heads going, I have no idea. This is one of the things that we use. So it's something that you can learn to become better traders. So again, I hope that helps. I want to wish everybody a very happy upcoming weekend. If you can, join us at 5 p.m. Eastern time for our cocktail hour. And if not, we'll look for you on Monday for another trading tune-up, and we'll see you then. Have a good weekend.